Hello, everyone. I hope you all are doing good. So let's begin with our session today. We will be discussing choosing an entity and tax considerations. And this session will be conducted by Mr. Kushank Sindhu. He is a lawyer licensed to practice in India. And as we were discussing with Kushank in the afternoon, um, this topic is very, very exhaustive, and we would definitely need one more session. We need two sessions. One is going to happen today. We will need two sessions to complete it. And as for now, we would just want to keep our class schedule as it is. So we will be having part two on Tuesday, late evening at 7 p.m. Hope that's okay with you all. Yeah. Any conflicts on Tuesday for anyone? So shall we have our session Tuesday, late evening, 7 p.m.? We would be continuing. So today is going to be a part A of this choosing an entity and tax consideration. Part B would be on Tuesday, 7 p.m. I hope that's okay with all of you. Say yes. Okay. So we are not going to, thank you so much. And again, very important things. We have been reminding you all through emails and messages. I just want to remind you all again here, the course is not only the live class, there are pre-reads, which includes watching the videos, doing the MCQ assignments, and reading the materials if given. So make sure that you are well prepared before the class, because here, as you're aware, the live classes are more on interaction, discussion. They're in a workshop mode where we clear all our doubts and talk about assignments. So you do the readings, and the practical aspect of the subject is taken up in the class. And do take care. Number two, do take care of the assignments deadline. Very, very important. So there are only 8 extensions which are available for the whole course. So do take care of it. And thirdly, again, a very important aspect is the class participation. Another most important aspect, a very, very important prerequisite to the successful completion of the course. So do take care of that as well. Okay, and do let us know in advance in case there is any conflict, you are unable to attend the class. We'll try to sort it out for you all. And that's all from my side. And you all can ping me in case you have any questions. And now I would just like to hand it over to Mr. Kushank Sandhu. Kushank, over to you. Maybe we can start the session with your intro first. Over to you, Kushank. Thank you.
Right. Thank you very much for the introduction. And well, the class today is essentially, as ma'am has introduced, it is basically to look at the tax considerations of choosing a business entity. Now, just to sort of recapitulate on certain aspects, which I'm sure you have already done through your e-lectures and also the classes which have been going on, that for any business enterprise, if you have to choose what kind of business entity you want, whether it has to be a sole proprietorship, whether it has to be an LLP or a Section 8 company or a society or private limited or one-person company or whatever, there are different considerations which go on. And that really depends on a lot of factors. Some of the basic factors are, first thing would always be that what is the nature of business that you want to provide? Is it something which in relation to manufacturing? Then what is the target audience? What are the geographical locations? How would you be able to manage? Those are things which go on when you are deciding what kind of business entity you want to operate. Now, another very important aspect which you should keep in mind whenever you're choosing the kind of business organization that you want your business to be formed in is basically the taxation aspect. The taxation aspect, because tax is something which is complex, it is complicated, it requires help to understand. More importantly, there is a lot of time, money, energy, and effort. All these things which go on if you have to ensure that there has to be adequate time, there has to be adequate tax compliance. Now, in whichever form you want your business to run, the fact that you should comply with the taxation laws, the fact that you have to pay your taxes on time, that is a prerequisite. There is absolutely no going around it. Then that clarity we should all have before we proceed. However, there are ways in which you can plan your taxes in such a way that can reduce the liability. Even if it does not reduce the liability, at least the compliance burden that can be reduced, all within the framework of law. The law in India itself provides a lot of incentives to ensure that businesses of all kinds are able to flourish with as little complexities as possible. However, having said so, whenever you are choosing what kind of business entity and what kind of tax, what is the kind of entity you should have, which is most effective and efficient from the tax compliance point of view, always keep in mind and always try to forecast how much you are going to spend on taxes. Now, that is definitely with some help. You can obviously reduce whatever your compliance burden is there, because compliance, as also the actual tax which is spent for a small business at least, it can amount to a substantial amount of money. So, this is definitely something that you should keep in mind. Now, as was already discussed, the class as such has been divided into two parts. One part we will be dealing with today, and the other part we will be dealing with on Tuesday. Now, your queries, doubts, etc., we can obviously have the interaction today, or you can keep it for Tuesday, because they both form, part of the same continuum. But today, what we will be looking at are essentially four aspects. One is that we will be looking at what is a sole proprietorship, number one. We will be looking at one person companies, number two. Number three, we will be looking at Section 8 companies and registered societies, in the sense of that between the two of them, what is a better form, what is a more tax compliant, and what is easier from the tax structuring point of view. The fourth aspect that we will be looking at is that what are the benefits, etc., that these Section 8 registered societies, etc., have. So, to begin with, let us first look at a simple sole proprietorship. And as again, I would just like to bring you back, to the earlier discussion, which I'm sure you have had, which is about the kinds of different organizations. So you would recall that sole proprietorship is a very basic and the simple form of business organization which you can set up. All your, the grocery stores, your milk store, etc., if they're not connected to a more larger company or a larger system, they are all in the nature of essentially of sole proprietors. You go to shops, especially in the old cities or different cities, older parts of different cities, you will find that there are businesses which have been running through generations. Some are obviously partnerships and LLPs, but I'm not getting into that. I'm just talking about the traditional sole proprietorship that you have. Now, why did I say that the sole proprietorship is the simplest form of tax? Because the first thing you have to understand is that the income tax, whatever is payable on the sole proprietorship. Now, what is the sole proprietorship? And let us understand that sole proprietorship, by definition, means that there is just one person who's running the company, who's running the business. That is the most simple form of understanding. So naturally, if that one person is the karta dharta, so to speak, of the business, if no one else has to gain, no one else has to lose. If he is the or he or she is the main person, so there is no separate taxation which is involved when it comes to sole proprietor. The sole proprietor, you would remember, and everybody I'm sure knows, especially for salaried individuals, there is an entire table which is there, which says that from X to, if your tax falls in this bracket, if your annual income falls in this bracket, you have to pay this much. If your annual income falls in this bracket, you have to pay this much. Every budget since the beginning of this budget exercise, they all have these tax brackets. So the sole proprietorship and the individual tax brackets remain the same. So because there is nothing different or nothing separate you have to do for your business. What you file for your individual, whatever the owner has to file, In that, in his returns only, the income, whatever he has generated from the sole proprietorship, that will be added. There is nothing, there is no separate, taxation exercise that you have to do or you have to carry out for the tax compliance aspect. It is all the same. Of course, there are different deductions and expenses which are allowed, which you can always take. For example, if you're running a small shop and then there are running expenses like photocopying or electricity or whatever, those are regular deductions which are uh, possible. So that is something that is there, but the basic principle, basic funda is that they are all the same. So that is a fundamental point which you have to keep in mind. Now, apart from the fundamental point that the income is essentially clubbed into one, there is also a surcharge that you have to pay. The surcharge which is applicable from it is basically 10% which is applicable if your income falls between 50 lakh and 1 crore. If, however, the income exceeds 1 crore, the surcharge is payable at 15%. So this is one thing that you have to pay. Apart from this, there is a health and education cess at 4%, which is chargeable. And the biggest thing is that one of the tax compliance things is that you have to pay the advance tax. Advance tax has to be paid. Basically, in the previous year only, you have a lot of deadlines within which you have to pay whatever tax is accruing. There are deadlines on which you have to pay, so that has to be complied in time. So again, that is the same thing with individuals also. That also you would have heard that advance tax has to be paid. Advance tax has to be paid. That is also very regular feature. Now, having said so, apart from all this, and originally when I had said that the government has a lot of programs, a lot of schemes when it comes to encouraging small businesses, etc. So one of those schemes which is allowed is basically the scheme for presumptive taxation. What is presumptive taxation? Presumptive taxation, simply put, is this: that there is a fixed amount, there is a fixed percentage which is determined to be your income. So you don't have to, it is either 6% or 9%, that also varies. That is the income, that is the tax that you have to pay. That is a fixed percentage which is there. So you don't have to have very detailed calculations and detailed assessment as to how much is your tax liability. And the reason for introducing this presumptive taxation, they have given it on the, as the government has said, it is to give relief to small taxpayers from the tedious job of maintenance of books of accounts and getting the books of accounts audited. The Income Tax Act has framed a presumptive taxation scheme under sections 44AD. These sections are very important: 44 capital AD, then 44 capital ADA, and 44 capital AE. So if there is a taxpayer and he is adopting the presumptive taxation scheme, then there is a fixed rate at which he can declare his income and he can pay the income tax. So this basically reduces, as I said, your compliance burden. Otherwise, what happens is then there is the whole issue of auditing, maintenance of books of accounts, etc. See, books of accounts, it is obviously always advisable to maintain whether or not the law requires it. But audit is something which should also be carried out. And in presumptive taxation scheme also, there is some flexibility given when it comes to the maintenance of books of accounts. So that is one very important aspect. Apart from that, when it comes to sole proprietors, there is a rebate which is given under section 87 capital A. This rebate is given if your taxable income is up to 5 lakh. If the taxable income is up to 5 lakh, you will get 100% rebate on the income tax that you have to pay. Whenever there is a taxation which has to happen, then there are different heads of taxation, and then there are different steps in which your income is determined, and then from that the deductions happen. For instance, first you calculate that whatever are the total receipts which have come into your business, that is added under the head of income from business or profession. From that you deduct whatever is the expenses, etc., that you have to give. Now, after coming to all of that, if your taxable income is still up to 5 lakh only, it comes that the taxable income is 5 lakh, then you get 100% rebate. This is under section 87A. Again, the idea is to encourage the small time businessmen. After this tax rebate is basically allowed, so once the taxable income comes and then you get your income tax, it is after that the surcharge that we had discussed about, for which is 10% if it is 50 lakh to 1 crore, and 15% it is if it is upward of 1 crore, which will be imposed, and then the 4% of health and education cess will be imposed. This by and large is what the sole proprietorship, how the taxation of the sole proprietorship happens. Now, one thing is very important to understand, that why are we, there is something very important to understand when it comes to liability to pay tax. Now, sole proprietorship by its very nature, as you all know, basically the business and the individual is merged for taxation purposes. For whatever liability that the business has, the entities, both of them are merged. There is no separation between the two. Now, what happens in these cases is there is this concept of unlimited liability, which is there, which is also there. You would recall, even under the regular law, there is the unlimited liability which is imposed on the businessman, which basically means that the businessman will be personally liable for whatever debts is owed by the business. There is no segregation between the two. What that also means is, in the concept of taxation, that whatever liability the business has to incur when it comes to tax is personally attributable to the owner also. He can be held liable if there is any deficit in payment of taxes. He can be held liable if there is any falsification of accounts, etc. It is also there in the other entities also. But this is more in the context of sole proprietorship. So if there is any, what happens with businesses is that, especially businesses which are obviously big, then there is this constant engagement with the income tax authorities. And if it is found out that there is some, evasion of tax, so whenever it is found out that there is some evasion of tax, there are two or three things which can happen. One is the recovery of tax aspect, where the assessment happens and your tax is recovered. The other aspect is the prosecution, which can happen against the business owner for evasion of tax. Now, for the recovery of tax also, the income tax department can proceed against the owner of the sole proprietorship. So in that in that procedure, he cannot, or he or she cannot say that it is the business, I have nothing to do with it. No, because they are the same, the tax authorities can theoretically recover whatever tax amount is due, along with penalty, interest, everything, from the person who owns the business. This is one downside of sole proprietorship. It is not a downside. It's just something which one has to keep in mind. Of course, the downside will only be activated if there is evasion of tax. So why evade tax in the first place? So in any case, this is with regard to sole proprietorship. Now, the next business organization, which again you would know, which is very connected to sole proprietorship, and then we'll discuss the relative pros and cons of both, is basically what is known as a one-person company. There is a lot of, it is an innovation. It is an innovation of Indian law, though obviously it was there outside also, your one-person company. But recently, this concept of one-person company has been introduced. And, theoretically, it looks the same. That even in a sole proprietorship, there is just one person who's owning everything, doing everything. Here also, there is one member of the company who's there. But there are differences between the two, and that happens because of the very nature of the word company which is used. One-person company, you would recall, has been defined under the Companies Act. Under the Companies Act, there is a definition of one-person company there, which you can write down. It is basically Section 2, Clause 62 of the Companies Act. Section 2, Clause 62 of the Companies Act basically defines a one-person company to mean a company which has only one person as a member. So, by definition, as I said, it will appear that the one-person company and the sole proprietorship are very similar. But the fact is that it is not the same. And why is it not the same? It is because of the very nature of the one-person company. So, if you have to, for whichever business organization, if you have to understand that the nature of compliances that the organization will have, first of all, you have to be very clear about what the company is, what the business organization is, how it is functioning, because the tax compliance is based on that what is the nature of the company, how is the company functioning, how are the decisions being taken, etc. That is why you have the distinction between sole proprietorship, one person company, LLP, etc. Because of the nature of ownership of the company, because of the nature of management of the company. It is on those principles that the tax burden and the tax compliance is there. Now, the first thing that you have to understand of a one-person company is the theory, as you would recall. It is basically essentially that it has a separate, it is a separate legal entity. It has a legal entity which is distinct from its members. So it has a separate existence. It has a separate PAN card, everything that you will have to have from the members. There will be two absolutely distinct entities even for taxation purposes, for legal purposes, etc. But the issue with your one-person company is that in a sole proprietorship, if you recall, when I talk about maintenance of books of accounts, audit, which has to be done, etc., those things come only if you have invoked the presumptive taxation scheme which the government has offered. Over here, however, when it comes to one-person companies, as a rule, you should maintain proper books of accounts, and it is also advisable to get the same audited. There also sometimes there is a threshold which is imposed that if the total income is beyond a certain level, only then the audit has to happen. But normally, because one-person company is essentially a company, that is why there is an audit which is done and the books of accounts have to be maintained. Now, the other thing is that the compliance burden in a one-person company, it might be easier when it comes to the income tax aspect. But the problem with the one-person company is it might be easier in from the income tax aspect compared to a private limited company, which is obviously bigger. But the problem that arises is that under the Companies Act, as it is, several filings have to be carried out with the ROC on a periodic basis. Because the filings have to be carried out with the ROC, people generally end up practically maintaining everything properly, and they should. But again, the compliance burden increases because if you have to maintain proper books of accounts, audit, etc., it is an expensive exercise. Not an expensive, I mean, it is just something that a business has to pay for. That is one important aspect of it. But what happens in a one-person company is that there are certain remunerations and salaries which are payable. Now, if you recall, in a sole proprietorship, everything is merged into one, and everybody has to pay tax on whatever whatever final amount has come. But in a one-person company, because there is a distinction between the management and the ownership of the company and the company as such, then the remuneration and the salaries which are paid out through a one-person company, that can be deducted from the income of the one-person company. And then you do not have to pay tax on whatever these expenses are allowed from that one-person company. So basically what happens is that whatever your taxable income is there, that keeps on reducing, because once a taxable income comes, you keep on removing that salary, expenses, electricity, etc. Now, why is this important? Because what in a situation, what can happen is that the salary which is payable to the owner of the company may be, and the salary what the owner of the company finally gets may actually be less than it will obviously be much less than the actual income of the one person company. And then you will have to see that whatever the salary is there, whatever income tax slab, that owner is falling under. So that calculation you will have to do, because then what you end up doing is that you pay salary, you pay tax through the one person company. You also pay tax through the owner, and owner will pay his individual tax under his individual slabs. Now, when the owner pays his individual tax based on his own tax slabs, then there are different deductions and expenses that even the owner can claim from his own income, in his own income tax returns. That is possible. That is like any other salary, or that is like any other remuneration. So uh, the income of the one person company keeps on reducing. So the tax amount obviously keeps on reducing. So till now, it will appear that there is an advantage that people are getting, because in the tax slab you can reduce the tax slab under which you are actually following. But then there are other issues also, which I will just come to. And that is the concept of minimum alternate tax, MAT. But before I talk about the minimum alternate tax, there is something called the DDT that I would like to mention about, which is known as the dividend distribution tax. Now, dividend distribution tax, whenever a dividend distribution has to basically happen to the owners of the company. Dividend, you would all, I'm sure, know that it is basically something like an incentive which is given out to people who are the shareholders of the company, especially if the company is doing well. Now, dividend is something which is given to shareholders, and obviously, in a one person company, the only shareholder is that one person who's the member of the company. But under the concept of DDT, the dividend distribution tax, earlier what used to happen was the income which was the money which was given out through dividends to the members, it would be taxed at two levels. It would be taxed at two levels. One level would be that it would be taxed at the stage of the company. So the company also ends up paying tax on the dividend, which is distributed. Obviously, it would be of a small amount, but still a tax would be there. The other aspect is that the same dividend amount would be taxed in the hands of the shareholders, because it's obviously income for the shareholders. Now, from the assessment year 2021 to 2022, the domestic company isn't required to pay the dividend distribution tax on any amount declared, distributed, or paid by such company by way of dividend. Dividend received from domestic company is taxable in the hands of shareholders. It is taxable in the hands of shareholders because it is income for them. So they will ultimately have to end up paying tax on the dividend which is received. Now, the problem with this is DDT, or dividend distribution tax. That is a concept that has been, that has been evolving, and that keeps changing from Finance Act to Finance Act. So sometimes it is there, sometimes it is repealed. So this is one problem which is there. The DDT might just come back, and then tax will have to be paid. The other point that I was talking about, the minimum alternate tax, MAT. There is a concept when it comes, this is there even when it comes to sole proprietors. There is something called alternate minimum tax, which is there. Now, the concept of minimum alternate tax was introduced to basically tax companies who could reduce their taxable income based on the different expenses that they would claim. So what would happen was that the company would earn money, the company would pay salaries, pay remuneration, etc., to all its shareholders, to the members, directors, etc. And then that money would be reduced from the taxable income of the company which was earned. Consequently, what was happening, that even though the company was running and properly, and the company was making money, but because of these deductions that the company was able to claim, ultimately the tax liability of the company used to become almost zero, and the taxable income of the company would become almost zero. So to avoid this situation where the government does not get revenue from this almost zero or nil taxable income, they introduce the concept of minimum alternate tax. And minimum alternate tax is something which is payable, which is like a minimum tax. It is around, I think it is around 15%, which is payable when it comes to these companies. So that is also something which you should keep in mind while understanding how much it has to be paid. Now, this section, which you can note down for this minimum alternate tax, is section 115 G, capital J, capital B. This talks about your minimum alternate tax. Yeah. So this is one section which you can note down for your, yes. Now this minimum alternate tax that for one-person company, I think it is around 15% or 18.5%. One of these two, which is mandatorily, which has to be paid to the government. Now, the other aspect which you have to look at when you're talking about the tax compliance is the statutory tax audit. Now, tax audit, the point is that if you are earn money which is more than 1 crore, then statutory tax audit is mandatorily to be done as per the provisions of the Income Tax Act. That is something which has to be kept in mind, and that is something which is very important, especially for businesses which are just starting out, because as I said, it is one of those things which takes time, money, and energy and effort. So that is another aspect that you have to look at when it comes to one-person company. The third aspect that you have to look at is basically, a set of three sections, and that is section 115 capital B capital A, then section 115 capital B capital A, then section 115 capital B capital A capital B. When it comes to your section 115 capital B capital A, now basically these set of three sections, if you are falling within the categories and the specific kinds of companies which have been defined in these three sections, then you have to pay income tax based on whatever these three sections tell you. Now, for example, I'll tell you, when you talk about section 115 capital B capital A, it talks about tax on income of certain manufacturing domestic companies. Here it says that the tax will be calculated. I'm just coming to the most important part, which says that tax will be computed at the rate of 25% if there are certain conditions which have to be fulfilled. Those conditions are that the company has been set up and registered on or after the first day of March 2016, or the company is not engaged in any business other than the business or manufacture or production of any article or thing and research in relation to or distribution of such article or thing manufactured or produced by it. Now, similarly, there are certain relaxations which have been given to different kinds of companies in the other sections also, which is sections 115 capital B capital AA, then 115 capital B capital A capital B, which are basically, the idea is to encourage the manufacturing industry. If you fall in these categories which are there, then you have to pay the specific amount of tax which is mentioned in these three sections. Now, while one more thing very important is that these three sections do not specifically limit themselves to one-person companies only, because it uses a very wide term, and that is a domestic company. So it is not as though only one-person companies will be covered by this. But still, the reason I pointed this out is that these are special sections within the Act which are distinct from the sole proprietorship section, which basically just merge everything under the head of the individual who's owning it. These are things which apply to one-person companies distinctly from sole proprietorships.
So sorry to interrupt you. The first section that you told, can you repeat that?
115 capital B capital A.
Thank you.
The other the other section which is very important is section 80 capital I capital A. Now, this section also provides for several deductions, especially for those undertakings, those enterprises which are indulging in, which are basically industrial undertakings or enterprises engaged in infrastructure development. Hence, the title of the section says deductions in respect of profits and gains from industrial undertakings or enterprises engaged in infrastructure development. If you fall again within the categories which are mentioned there, then you are subject to, then you can take several other kinds of deductions from the profits. So deductions, I hope you all understand that deductions are basically if you are earning 100 rupees, and then if you can take a deduction of an expense of say 20 rupees, you say that out of the 100 rupees that I have earned, 20 rupees I have paid on my electricity charges. Simply put, because every business will have electricity which has to be paid. You can say that out of the 100 rupees, if 20 rupees I have paid on electricity, I don't have to pay tax on the 20 rupees. So my 100 minus 20 becomes 80. So I ultimately have to pay tax only on that 80. This is what deductions means. And it is in this context you have to then look at these sections that I'm talking about. Now, from all this discussion which has happened, one thing you would have understood by now is that there is a distinction between a sole proprietorship and a one-person company. There are two different concepts. They come with their own pros and cons about different aspects of taxation, about the computation of tax, about the liability to pay tax, the imposition of tax, the incidence of tax, etc. Who has to pay tax, how much. This is from the income tax perspective. So while you are examining what kind of business organization you have to adopt, you will have to do some kind of, first thing is you will have to do a projection of the revenues that can come in from the company or from that business. That projection, you will have to merge it with the kind of structure you want to have of the company depending upon the nature of business activity. Obviously, if say for example you are setting up a shop in a colony where you just want to sell groceries in the same colony, then for that there is no need to have an entire full-fledged company. You can just work with a sole proprietorship. However, if the same thing, if there is, for example, a startup and they want to run this in different cities or even different parts of the same city, they would want some more professional expertise. They would want some more, technical expertise, etc. And in those situations, the one-person company becomes more relevant. But having said so, from the taxation point of view, you will also have to undertake this exercise of seeing that where your compliance burden is more and where the tax that you pay can be legitimately within the frameworks of law if it can be reduced. So that analysis would depend upon fundamentally the revenues that you're projecting that will come into your business and from what sources and to whom you have to pay. Do you have a group of people who are running it who have to be paid salaries at a more regular level, or do you have just one person who has to be paid? Or another aspect is that if you are thinking that your organization cannot run only on one person, it requires multiple people to run. So you may not have a lot of control as a business owner on a lot of aspects. So in those aspects, you have to be careful and you have to limit your liability. because there might be certain things that the company does to which you have never authorized them to do. In those cases, you have to protect yourself from the taxation perspective also. And in those cases, the one-person company might be better than a sole proprietorship. So this is the whole reason, and this is the whole discussion about the concept of limited and unlimited liability when it comes to sole proprietorship and one-person company. The other aspect that you have to look at is when we're talking about the two, is the compliance burden, which is very much related to the first aspect. And but here I'm not talking about the compliance burden as to who will be responsible for what. I am on the point of the level of audit that you have to do, the kinds of filings that you have to do with the ROC and the income tax. Maintenance of these books of accounts, doing the statutory audit all require money and energy and resources. So there also you will have to do an analysis of how much you are willing to pay for this compliance. The third aspect, which is very important, is, as I was talking about, was this dividend distribution tax. Now, as of now, the dividend distribution tax has been removed from the assessment year that I had mentioned, 2021 to 2022. But that is something which there is, sometimes there is a flip flop. There is a flip flop when it comes to the DDT, the dividend distribution tax. If at a later stage, after you have set up your one-person company, suddenly the dividend distribution tax is introduced, then that would increase the tax liability which is being imposed on the owner of the company. So at that stage, then it will become very difficult, because at that stage you would have already advanced in the business to some extent to then go back to a more fundamental or a more rudimentary level. So that is one downside of having a one-person company. Now, the fourth aspect is the group of sections that I had mentioned about, sections 115 BA, BAA, and BAB. Now, that is basically, there is a flat tax which is imposed, sometimes 20%, 25%, whatever, if you fall in those categories which are mentioned in those sections. Now, if you fall and there is a flat tax percentage that you have to pay, it basically means that there is it is easy to forecast how much you have to pay. Whereas if you talk about the sole proprietorship, then there is something called progressive taxation which is there. So the percentage also increases depending upon the increase in the taxable income. So that mathematics you will have to do, that if you say, for example, if it is 1,000 rupees that you are incurring, and 1,000 rupees that which is your taxable income, if that 1,000 rupees, will it be cheaper for you to pay had you been a sole proprietor, or if it would be cheaper for you to pay had you been a one-person company? So that is also one big difference which practically happens whenever we are structuring these organizations. The last aspect is, again, on a more practical note, is about your entire credit score, which is there. So credit score is something which I'm sure a lot of you know, that it is about basically companies such as Sybil and all these companies, they record the level of the kind of transactions you all do, and be it your credit card payments, credit cards, loans that you have taken, etc. Now, in a sole proprietorship, that is the dues, whatever the taxation authorities are imposing on you, that can personally affect your credit score. But on the other hand, if there is a one-person company, it should not make that much of a difference, because the dues of the one-person company will be distinct from the dues of the member of the company. But lastly, I would like to say one thing, that please do not think that the moment you choose a one-person company, you are entirely protected from all kinds of issues which may arise, be it from the taxation aspect or be it from any other aspect that you're talking about, only under this banner of unlimited liability or limited liability. Practically, it doesn't work that way. if there is an evasion of tax in the company, in the one person company, and you are the only person running it, owning it, doing everything, despite the fact that it is a one person company which had to pay tax, you can still be held liable, and prosecution can be initiated against you for the whatever the mistakes of the one person company is there. So that way, do not feel that tax evasion you do in a one person company and nothing will happen to you. It does not work that way. Of course, it depends on the facts and circumstances of every case, as with everything else that we talk about. But this is very one important aspect of liability that has to be understood. But yes, when it comes to the recovery of tax, it is normally in a sole proprietorship, you personally recover, you the taxation authority, or for that matter anybody to whom you owe any kind of money, that is something that you can that is attributable and that can be taken from the owner, whereas it is distinct when it comes to one person company because it is a separate legal entity which is there. The other aspect that I wanted to talk about today is basically, now that we are done with this whole proprietorship and one person company, which from the discussion you would have understood that it is on a slightly simpler note. But you know, the one person company and sole proprietorship are virtually on the same as I said, in the same continuum, because it is one person company is just an evolution of your sole proprietorship. The other aspect that I wanted to talk about is basically your Section 8 companies and registered societies, which are there. Now, first of all, let us understand what is a Section 8 company. Section 8, why do we say Section 8 company? Because you have to look at what the Companies Act talks about, Companies Act 2013, when it talks about a Section 8 company. Section 8 company, to understand Section 8 company basis, you have to go to Section 8 of the Companies Act 2013. Now, if you look at the provisions of Section 8 of the Companies Act 2013, it basically talks about your formation of companies with charitable objects, etc. Both when it comes to Section 8 companies and registered societies, normally the discussion is in relation to the charitable objects of the company. For instance, if there's an orphanage which is there, or if there is a society which has been established for the propagation of art or culture or music or dance, and they run on a no profit basis, and they're genuine if their motive is to ensure that there is propagation and promotion of these things, it is in that context that this discussion is important about Section 8 companies and societies. So there are a lot of benefits which are legitimately given to these entities. So to understand a Section 8 company, you have to look at Section 8 of the Companies Act, as I said, which says, where it is proved to the satisfaction of the central government that a person or an association of persons proposed to be registered under this act as a limited company. So the next part is very important. A, has in its objects the promotion of commerce, art, science, sports, education, research, social welfare, religion, charity, protection of environment, or any such other object. B, intends to apply its profit, if any, or other income in promoting its objects. And C, intends to prohibit the payment of any dividend to its members. The central government may, by license issued in such manner as may be prescribed and on such conditions as it deems fit, allows that person or association of persons to be registered as a limited company under this section without the addition to its name of the word limited, or as the case may be the words private limited, and thereupon the registrar shall on application in the prescribed form register such person or association of persons as a company under this section. So if your organization is falling under A, B, and C, and this is a company that has to be established under A, and they are going to perform to the satisfaction of the central government, of course, because they have to register, they have to certify that you're falling under this. If you fall under A, B, or C, then you can register as a Section 8 company. Plus, this proviso is very important. The advantage you get is that you do not have to use the words limited or private limited in your name. So, if it is, for example, something like, some academy of sciences, academy of dance, or academy of music, if it is a company, if it is doing all of this, then it can be registered under this section. So, as I said, these are provisions which have been introduced to encourage the promotion of arts, culture, etc. The other thing very connected to, other aspect which is very much connected to a Section 8 company is the whole concept of societies. Societies, all of us know that, societies are formed again for society, for example, for the protection of people, for the protection of the disabled, or for the propagation of art. So those societies are registered under the Societies Registration Act 1860. Normally, these NGOs, etc., they are registered either as an NGO, either as a Section 8 company, or under the Societies Act 1860. And then there are trusts and other forms also. But today, our discussion is limited to these two aspects. One is society, and the other is your company. Now, when you talk about, again, because we're talking about the taxation aspects, we are not talking about really and I'm not talking about the management of the company, etc. But once you have taken the call from the more management point of view, that also depends on, as I said, on the objects that you have to perform, on the way in which you have to provide these services, or the way in which you want to promote yourself, or promote culture and arts and music, etc., with or without liability. Once you have taken that call, then when you look at taxation aspects, then when you open the Income Tax Act, there are a group of 3 sections which are very important when it talks about the exemptions and the incentives which are given to these organizations. And those are sections 11, 12, 12 capital A, 12 capital AA, and 13. We look at all 3 of them. So first, if we begin our understanding with section 11.
Now, can you repeat the section, please?
Yeah, the first section is section 11. Section 11, basically, these provisions are attracted when because of these charitable charitable organizations. Normally, these group of 3-4 sections are invoked. Section 11 says income from property held for charitable or religious purposes. Subject to the provisions of section 60 to 63, the following income shall not be included in the total income of the previous year of the person in receipt of the income. Income derived from property held under trust wholly for charitable or religious purposes, to the extent to which such income is applied to such purposes in India. The second thing is, when you look at 11(1)(b), income derived from property held under trust in part only for such purposes. Then C is derived from property held under trust created on or after the 1st day of April 1952. Then for charitable or religious purposes created before the 1st day of April 1952, etc. This part is very important. Income in the form of voluntary contributions made with a specific direction that they shall form part of the corpus of the trust or institution, subject to the condition that such voluntary contributions are invested or deposited in one or the more forms which are specified in subsection 5. So this is the first section which is very important, which is section 11. The next section which is very important is, in this context, is section 12. Now, section 12 is very important. Section 12 says income of trusts or institutions from contributions. So just, I would like to talk about 12, 12A and 12AA. There are several judgments which, interpret these sections. These sections basically talk about 2 things. One is the kind of benefit that you get once you are, getting all these voluntary contributions, etc., as an SSE. The other aspect that you get is the procedure, and which is primarily captured in 12 capital A, capital A. It is the procedure of getting these certificates or licenses as per which you can be exempted. So coming back to 12, then when we go to 12 capital A, then you will understand that how it is important. 12 says income of trusts or institutions from contribution. 12.1 says any voluntary contributions received by a trust created wholly for charitable or religious purposes or by an institution established wholly for such purposes. So it is not just a trust, but an institution established wholly for such purposes, not being contributions made with a specific direction that they shall form part of the corpus of the trust or institution, shall for the purposes of section 11 be deemed to be income derived from property held under trust wholly for charitable or religious purposes, and the provisions of that section and section 13 shall apply. Now, if you could come to section 12A, which talks about the conditions for the applicability of sections 11 and 12, then there are these conditions which have been mentioned, which talks about how the form, etc., has to be issued by the principal commissioner or commissioner of income tax or whatever. And section 12AA basically talks about the procedure for registration. The principal commissioner or commissioner, on receipt of an application for registration of a trust or institution made under clause A or clause AA of section 12A, shall, then there are different steps which have been prescribed, which is basically the procedure for registration. So 12AA, as I said, talks about essentially the procedure for obtaining the relief, which is provided under the previous set of sections. Now, the reason why I'm discussing these is that the government itself says that the tax relief was introduced keeping in consideration that non-profit entities work for social welfare and not for generating taxes. There are two more sections which are important, which is section 80G, which I'm sure a lot of us have heard about it. Section 80G. If you have the prescribed registration under section 80G, then you get the income tax benefit, which is there. There, normally what you get is a 50% rebate on the donations which have been maintained. So that is the advantage. The 80G advantage is basically enjoyed by both the person who's donating. From their taxable income, also the 80G can be reduced to some extent. The other entity which which profits is basically the recipient of that donation. So there can be a 50% rebate against the donations which have been made. Now, the last section, which is important, is section 35, capital A, capital C. Now, when you look at this section, this basically talks about expenditure on eligible projects or schemes. Where an assessee incurs any expenditure by way of payment of any sum to a public sector company or a local authority for carrying out any eligible project or scheme, the assessee shall, subject to the provisions of this section, be allowed a deduction of the amount of such expenditure incurred during the previous year. So this is also one section which is normally applied when it comes to these companies and the societies, because it is in this context only in which this 35 AC has been introduced. Now, the reason why there is this discussion was happening is that the 12A registration, which I wanted to emphasize, that practically speaking, this 12A registration is very important for all these entities, whoever are engaging in these charitable or religious or cultural purposes. Without obtaining this 12A registration, it becomes slightly different and slightly difficult to get these benefits, because without the valid 12A registration, all the amount actually theoretically becomes taxable. Now, practically speaking, there are situations where there is a delay in the formation of the company and getting a 12A registration. So that has been covered by the Karnataka High Court in a judgment, which I will give in the next class, where it talks about when there is a delay, if that delay, if it is justifiable, it is fine, because it is natural that there would be some delay when it comes to obtaining the 12A registration. That is a settled position of law by the Karnataka High Court. But the Karnataka High Court thereafter in the same judgment, it talks about the interpretation of 12A, 12AA, etc. But 12AA, it's essentially the procedure for obtaining the 12A registration. The reason why that distinction is made in law about 12 capital A and 12 capital AA, it is because of the fact of the interpretation of the law changes once it is a procedural section versus when it is a charging section. That is, when there is some provision of law which talks about the charge which has to be imposed on the individual. So that is what the Karnataka High Court says. So just to recapitulate, in this class, what we have covered is, on the one hand, we had discussed about the OPC and versus the sole proprietorship. Sole proprietorship and OPC, while fundamentally it looks the same, but because of the organizational distinctions, there is a distinction on tax liability which is imposed. The kind of entity that you choose when it comes to OPC or sole proprietorship depends essentially on a mathematical calculation and projection of what is the kind of business you are doing and how you are forecasting that in which direction your income that you get will actually be spent. Based on that, you can do an analysis. What I had also advised in this study is that the protection of limited liability and unlimited liability is to the extent of the recovery of the money. But if there is some fraud which happens on the basis of which you try to evade tax, or there is some misrepresentation or fudging of accounts or whatever, then just because you are in a company does not mean that you are protected. If you are running the company, if you have been in charge of the management of the company, the tax authorities can come after you and can launch prosecution against you. So these are, but of course, there is a distinction when it comes to compliance requirements, etc., which is where you have to see and the expenses, which is where you have to see what is more suitable for your business. Is it a sole proprietorship or an OPC? The other aspect that we had looked at in today's class was the entire, the jurisprudence in relation to Section 8 companies and registered societies, in relation to the benefits that basically these two kind of corporate entities get. That where I had said that primarily the advantage that you get is once you have obtained the registration under Section 12A, capital A, where the principal chief commissioner or commissioner of income tax basically has to be convinced that whatever organization you are doing, it is basically for the charitable purposes or, without, it is a no profit enterprise. If you fall under that, then you get the advantages what these companies, Section 8 companies or the societies get. Now, just to give you an idea of what we will be doing in the next class, we will be, making it slightly more complex. And that is essentially in the nature of when we talk about partnerships, LLPs. Now, LLPs, when we talk in the next class, when we will be discussing about the partnership deed, and when there is basically something called the remuneration to the partners which are given out in a partnership deed. We will discuss about how whenever there is a remuneration which is given and whether or not it is stipulated in the partnership deed, then how does that taxation of that remuneration happens if you are a partner and you get. Again, these are all questions which will come when if you're trying to structure your organization and see what is the most tax efficient structure. So that is one aspect that we will be dealing with. The other aspect that we'll be dealing with is the capital contribution of a partner in an LLP. So when basically capital contribution of a partner means capital contribution need not always be in cash, by the way. In a partnership, capital contribution is a very wide term. Capital assets, everything is included in that. If that you bring into the company, then what will be the taxation aspects, the fair market value, etc., of that asset? Those things are aspects which we will be dealing with. The other thing that we will be dealing with. The third aspect that we will be dealing with is foreign partners when it comes to LLPs, and how can the foreign partner be taxed. That is also one thing that we'll be dealing with. So all this is in relation to LLPs. The other aspect that we will be dealing with is companies and the taxation of shareholders in companies. And that is when it comes to issuance of shares, dividends, bonus shares, share transfer, then how are the shareholders taxed? I had given you a small idea about it when I had discussed about the dividend distribution tax. And dividend distribution tax, where I had said that varies from finance act to finance act. It's not the amount, but it can always come back. And whenever it comes back, then it can be applied retrospectively also. Of course, it is more complicated than this in the sense of the entire jurisprudence of the retrospective taxation, etc. But the point is that this is one danger which is always there with companies. The other aspect is that in case of a foreign partner or a shareholder, if there is a foreign partner or a shareholder, what would be better? Would an LLP be better or a company be better from a taxation perspective? Again, I would like to clarify that this discussion, whichever is happening, is when we are talking about choosing the entity from the taxation perspective. So, taxation from that perspective, in terms of expense, compliance, requirement, liability, what would be best and what are the factors that you have to keep in mind. So, this is how we will go about it. Next class will be on Tuesday in the evening. And yeah, that's about it. Any questions on these aspects what we discussed today?
So the broad classification between a one-person company and a sole proprietorship was on the basis of one, taxation, which we have broadly discussed, and the ownership, and one you talked about, that it's the legal entity status. Both on that basis, the advantages and disadvantages can be created. And the third you talked about was a sum of ownership. Like one is a business owned by an individual and the other is another different entity, that is a company. Apart from this, is there any other broad category that has to be discussed, or this is all?
The other aspects that you have to, liability is one point.
Yeah, liability. Yeah,
liability is one point. The taxation requirements are different. Taxation requirements are different. If you fall under the three sections that I told you, then there is a flat tax that you have to pay, 115 BA, BAA, BAB, etc. The other aspect is when I was discussing about the presumptive taxation scheme, where you can pay tax at a stipulated flat rate of 8 or 9%, whatever is mentioned, which is enjoyed by sole proprietorships. And just to clarify the presumptive taxation scheme, the idea of that scheme is to basically encourage small businesses so they do not have to make very detailed accounts or pay a lot of money on audit of these accounts. It is basically for professions like me, like doctors, lawyers like me, etc. So you can pay just that flat rate and then go ahead with it. But the disadvantage of presumptive taxation is that once you pay the presumptive tax or whatever amount there is, then there are very less expenses which you can claim. It is assumed that after that you are paying that flat rate. So that is another difference which is there between a sole proprietorship and a one-person company. The other things that I had talked about was, largely, in the nature of audit, the rebate which is there under Section 87, capital A, which you get if your income is less than 5 lakh, taxable income is less than 5. These are the broad classifications.
So I have a question. So what is the current tax rate of OPC? Like any current fixed tax rate or like?
See, the current tax rate of OPC, if you are falling under the three sections which I mentioned, 115 BA 35%, 115 BAA it is 32%, and 115 BAB is 15%. That is one. The other thing is that the minimum alternate tax which is payable, that is either it is 15% or 18.5%, which is the minimum alternate tax that you have to pay. And then there are the different slabs and all, which
so like education says and all, like something.
Education says and all that is there. See, the cess which is given, there is a fundamental difference, please understand, between a tax and a cess, which is charge. Tax, cess, penalty, these are all different concepts. When you talk about tax, tax is simply put that portion of your annual income that you have to pay to the government for you can say that it is because we live in a social contract and we have a government, so we have agreed that all of us will pay and that is how we'll run. We need the government for providing us security, resources, etc. That is the concept of, broadly, the concept of tax. The concept of cess is when you talk about health cess, education cess at 4% which we pay. A cess is basically for a very specified purpose. Okay, like as I said, health or education. So for that 4% is charged. Surcharge is a different concept that if it goes beyond a certain level, you have to pay.
It's like TDS and all, surcharge like the TDS and all, right?
Surcharge is basically when you have to pay if your income is over a above level. TDS is a slightly different concept. TDS, as a lot of us would know, it is basically tax reduction at source. What basically means is, for example, I as a lawyer, when I am providing services of 1,000 rupees, somebody has to pay me 1,000 rupees for the services that I provide. The government says that whenever they pay me 1,000 rupees, from that they have to deduct 10% TDS. So they will deduct 100 rupees from that money, pay me 900, and that 100 rupees they will pay directly to the government. That forms part of the income tax which I have to pay in any case during the course of this year. Similarly, whatever I pay, whenever I have to pay, for example, I have to pay, to a lawyer, I have to pay something for something that they have done. So 10% I deduct from whatever I pay them, and then that 10% I deposit it in the company against the PAN card of that person to whom, I had paid the remaining amount of money.
Okay.
That is what TDS is.
Okay, sir. Thank you, sir.
Good evening, sir.
Yeah.
So these companies which are falling under, section 115 BA, BAA. So any company falling under these sections, they will get deductions according to these sections. But companies which are not falling in these categories, so the general tax rate would be 30% on them. What is the?
Whatever the general tax rate is there, that will be applied, which is 30%.
Okay, sir. Okay. And so secondly, sir, I had a question regarding salary of in case of 1% company. So there is any limit as to how much a 1% company can pay to the member? The person himself or herself will be the member, and the employee as well, maybe employee as well. So how much he can pay as a salary? The company, 1% company can pay a salary to himself.
See, the limit in the sense that it has to be reasonable, because see, whatever amount that you fix as the salary that which will be paid, it has to be on a legitimate service that the person is providing. So it is not that the person, see, one more thing, understand one thing. When there is a company, there is a member of the company who is also the shareholder of the company. So in his avatar as a shareholder of the company, he doesn't get paid anything. He only gets a dividend. But if he's also working for the company, then it is a different matter. So he also has to show that he's legitimately working in the company. That amount that he pays, that he is paid from the company, that amount has to be a reasonable amount of money. It can't be that when you look at the calculations, the tax authorities feels that you have set up a salary amount which is meant to only evade the taxation requirements. That is the general principle on which your taxation, on which the salary should be paid.
I have a question,
Okay,
sir.
okay, thank you, sir.
Sir, what if, sir, suppose a private limited company shares an issue shares through private placement or right issue? Do they divide any taxes on it?
If the private limited company issues shares
through private placement or the right issues, do they divide any taxes on it?
I'll cover that in the next class.
Okay, sir.
Because that is one aspect which is there when it comes to payment of issuance of shares, dividend, bonus share transactions, etc. That is one aspect. I'll deal with it in the other this thing, because basically the thing is that if you are through private placement, if you're doing shares or anything of that sort, then you will have to see whatever the taxation happens at multiple levels. If it is just buying of shares, then the person who's buying the share will be paying to the company. So the company will have to pay.
Okay.
But there also it is slightly complicated, because then, it becomes part of the capital of the company. So it's like people have introducing capital. So whether or not that capital is taxable, those aspects let me deal with the other ones.
Thank you, sir.
All right then. Thank you.
Thank you, sir.
Thank you, sir.